Usually, when we think about a bank, there's this expectation of something highly physical,
Mm.
like a giant, impenetrable steel vault, right?
Oh, absolutely. It's very compartmentalized. Traditional banking has, always been about these discrete services housed inside literal physical walls,
Right, exactly. You put your money in, you take your money out, and it's a very clean, straightforward, almost binary transaction.
which is fine for decades, but that model is incredibly static.
Yeah, it is. But then you step into the world of modern, hyperscaled Islamic finance, and suddenly that steel vault metaphor just, well, it completely falls apart.
It really does. You realize quickly that the vault is gone.
Because we're looking at a financial landscape today that isn't a vault at all. It's this incredibly complex, sort of invisible digital nervous system that touches, almost every aspect of a user's life.
Which is the absolute definition of a paradigm shift. We're moving from a place where a bank merely holds your money to a place where a bank actively manages your entire economic reality.
Welcome to this deep dive. I'm your host, Hamid, and alongside me is our resident expert, Huda.
Glad to be here with you all to unpack this.
Today, our mission is to explore AlRajhi Bank's 2025 Integrated Annual Report. We are going to dig into how the world's largest Islamic bank, by both assets and market cap, by the way, actually operates.
We really need to look at exactly who it serves and what drove its massive record-breaking profits in 2025.
Because if we look at the bigger picture here, this isn't just a story about a bank holding on to cash.
No, not at all. It's a highly detailed blueprint of a complete transition.
Yeah.
A shift from a traditional financial institution to a fully harmonized, completely Sharia-compliant digital ecosystem.
Okay, so let's unpack this. Because the sheer scale we are dealing with here, it requires a bit of perspective for you listening. In 2025, the bank surpassed 1 trillion Saudi riyals in total assets.
Which is just a staggering number to even visualize.
It really is. Specifically, they hit SAR 1,043 billion. To put a trillion riyals in perspective, well, they are managing a balance sheet roughly the size of the entire gross domestic product of a country like New Zealand.
Right. It's economy-sized wealth. It's massive.
So to understand how a single bank gets to 1 trillion riyals in assets, we first need to look at exactly what it is they are selling.
And that starts with the core strategy they're executing, which they call harmonize the group.
Harmonize the group. Okay, what does that actually look like in practice?
Well, the bank basically operates across 4 main pillars to make this happen. You've got business to consumer, business to business, their support businesses, and finally, digital and data.
Got it. So they break it down into those 4 distinct areas.
Exactly. But they are actively trying to weave these pillars together so tightly that you, as the customer, barely even notice you're crossing between different financial products.
And the sheer variety of those products is staggering. Plus, importantly, they are all entirely Sharia compliant.
Right, which adds a layer of complexity to everything they build.
Under their core banking umbrella alone, you've got personal financing, auto loans, and, traditional current and savings accounts.
But the real anchor product there is housing.
Oh, absolutely. They are absolute giants in mortgages. They are sitting at #1 in the market with a 37.7% share.
Which means more than 1 in 3 mortgages in the entire country is flowing through them.
Let that sink in. But that's just the retail side, right?
Yeah, on the corporate side, they provide point-of-sale financing for merchants. They do Mutajara financing.
Wait, let's pause there. Mutajara financing, just as a refresher, how does that work in this context?
Sure. So it's essentially a Sharia-compliant trade financing mechanism. The bank actually buys the goods and then sells them to the business at a markup.
Ah, okay. So it allows businesses to acquire inventory without taking on traditional interest-bearing debt.
Precisely. It keeps the transaction totally Sharia-compliant. They also participate heavily in the government-backed Kafala program.
Right, the SME support program.
Exactly. It acts as a loan guarantee system to support small and medium enterprises that, well, they might not have the collateral for a traditional commercial loan.
But building a bank today isn't just about offering loans anymore, is it?
No, not if you want to reach 1 trillion riyals.
Right. They've surrounded themselves with these highly specialized fintech subsidiaries to capture, every conceivable financial need. You have MCAN handling microfinance.
And then Neoleap is dealing with digital payments and digital wallets.
AlRajhi Capital is running the brokerage and wealth management side of things. Neotech is their engine for open banking and data aggregation.
And we can't forget their acquisition in the wealth tech space. They acquired a 65% majority stake in Drahim.
Which is an automated investment and personal finance management app, right?
Yeah, and that was actually the first of its kind investment by a Saudi bank in the entire region.
Wow, really?
Yeah.
So buying Drahim, that signals something bigger, doesn't it?
It signals that they don't just want to facilitate your daily transactions anymore. They want an algorithm to actively help you manage your long-term wealth.
I look at this business model, and honestly, it feels exactly like a smartphone app store.
Oh, that's a perfect analogy.
Because, just like Apple doesn't just sell your phone, they sell you iCloud, Apple Music, and the App Store, so you basically never leave their walled garden.
You're locked into the ecosystem.
Right. AlRajhi is capturing the user's mortgage, their daily coffee purchase via Neoleap, and their stock trades all in one closed loop. But I'd imagine building out all these separate fintechs is incredibly capital intensive.
It is a massive upfront investment, yes.
So isn't it highly risky for a traditional bank to try to build an app essentially for every single financial need instead of just focusing on basic lending?
Well, building an ecosystem is undeniably expensive. But the payoff comes in a metric they call multi-product adoption.
Okay, what does that look like in the data?
The bank successfully increased the proportion of customers using more than one product from 38% in 2023 up to 44.6% in 2025.
That's a massive jump. Almost half their base is using multiple services.
Exactly. That cross-selling is the entire secret to their efficiency.
So it's about acquiring a customer once, but monetizing them multiple times.
You hit the nail on the head. Let's walk through how that physically manifests on a user's phone. Say you download the app just to open a basic checking account.
Right, the marketing cost to acquire you initially is pretty high.
It is. But once you're inside, the app utilizes Neotech's open banking protocols. Neotech aggregates all your financial data, even from other banks, giving AlRajhi a complete 360-degree picture of your financial health.
Oh, wow, so they can see everything.
Yeah. Because they can see you pay rent every month on time, the app automatically offers you a pre-approved mortgage. When you finally buy the house, it offers you an MCN microfinance loan to buy furniture for that house.
And then it nudges you to invest your leftover cash through Drahim.
Exactly. Your cost to serve drops dramatically, while the value you generate for the bank multiplies.
It's all about stickiness. I mean, once you're in the ecosystem and your data is flowing seamlessly between all these subsidiaries, you really have no logistical reason to go through the hassle of opening an account somewhere else.
They're leveraging their existing customer base to instantly scale these new platforms, which entirely mitigates the cost and risk of developing them in the first place.
But, building that ecosystem is just a massive sinkhole for cash if nobody actually uses it.
Right. A great app is useless with no daily active users.
Exactly. The true test is whether they can actually change user behavior and get people to engage. So let's look at who is actually downloading this and living inside this digital walled garden.
The numbers are pretty staggering here, too.
We're looking at a retail customer base of 20.6 million total customers. And of those, 14.9 million are active digital users.
But they don't treat those 20 million people as a monolith, though. They have highly specific, hyper-personalized segments.
How do they break them down?
They break the base down into premium, expat, family, and mass market.
The expat segment really caught my eye in the report because historically, banks have focused on blue-collar expat workers, mostly for sending remittances back home.
Right. That was the traditional revenue driver there.
But the report notes they have actively expanded that segment to include highly paid white-collar professionals, which captures a totally different wealth bracket.
It really shows how granular their niche targeting gets. For instance, they even developed something called a gamer proposition.
Wait, how on earth does a bank target gamers?
By understanding what that demographic actually values, right? They rolled out a youth-centric digital campaign featuring exclusive gaming-branded card designs.
Oh, nice. People love custom cards.
Yeah, and they paired it with specific cashback rewards on digital marketplace purchases. It successfully drove card issuance and spending among a demographic that, frankly, traditionally ignores banking ads.
That is super clever.
And then you have things like AlRajhi Global, which is a tailored interface specifically for expatriates who need competitive, seamless international transfers. They are identifying highly specific user needs and building a micro experience around them.
And while they are targeting gamers and hiring expats, they are also leaning heavily into financial inclusion. The report highlights this as a core value.
Yes, inclusion is a huge part of their mandate.
They have 176 dedicated ladies' branches to ensure privacy and comfort for female clients. They're rolling out remote digital branches in historically underserved rural areas.
And they even built a specific home financing solution targeted at lower-income citizens.
Right, specifically those earning between SAR 3,000 and 7,000 a month.
The mechanics of that lower-income home financing are particularly clever. They combine the bank's Sharia-compliant financing with government subsidies from the Real Estate Development Fund, or REDF.
So how does that subsidy actually work for the buyer?
Well, the REDF steps in to subsidize the profit margin on the loan. That makes the monthly payments actually affordable for someone earning, say, 4,000 rials a month.
Ah, I see. It bridges the gap between commercial viability for the bank and their social responsibility.
Exactly. It's a win-win.
Plus, on the business side, their portfolio for micro, small, and medium enterprises, the MSME sector, grew a staggering 50% to SAR 58.7 billion.
So they are actively financing the small bakeries and local logistics companies, not just giant petrochemical conglomerates.
But I have a hypothesis here. Let's think about the user experience. If an institution tries to serve a high net worth VIP looking for wealth management, a low-income worker sending remittances, and a small bakery owner, wouldn't the app feel incredibly cluttered?
You would think so, yes.
Like, how do you avoid diluting your brand identity when you're trying to be a luxury boutique and a discount superstore at the exact same time?
Well, in the physical world, it's almost impossible for a storefront to appeal to everyone. But this is where their fourth pillar, digital and data, really does the heavy lifting.
Okay, so how does data solve the clutter problem?
By utilizing artificial intelligence. The bank doesn't show the same storefront to everyone. The app literally shapeshifts based on the data profile of who logs in.
Wait, really? So the interface I see on my phone is completely different from the interface you see?
Exactly. If you are a high net worth individual, your home screen prioritizes AlRajhi Capital Wealth Management dashboards and premium concierge services.
And if I'm running a bakery?
If you log in as an SME owner, the AI pushes point-of-sale financing and neotech accounting solutions to the top of your feed.
That is brilliant.
This data-driven personalization allows them to cater to vastly different demographics flawlessly. It's a major reason they've been able to maintain a 96-to-4 digital-to-manual ratio.
Meaning 96% of all customer interactions happen on a screen, not in a branch?
Exactly. It's wild.
Okay, so with the products built and the customers segmented perfectly with AI, we finally need to look at the scorecard. How does an AI-driven multi-product ecosystem translate into actual profits?
Let's trace the historic trajectory here because the climb really sets the stage for what happened in 2025.
Right. The trajectory over the last 5 years is basically a testament to this strategy taking root. In 2021, their net income was SAR 14.7 billion.
A solid baseline.
Then in 2022, it climbed to 17.15 billion. In 2023, there was a slight dip down to 16.6 billion.
Which, completely makes sense given the global shifts in interest rate environments during that specific period.
Yeah, everyone felt that. But then in 2024, they recovered and jumped up to 19.7 billion, and then we hit 2025.
The record year.
Net income after zakat, which for those who don't know is the mandatory Islamic charitable tax on wealth, hit SAR 24.8 billion.
That is the highest net income since the bank's inception.
That 2025 figure represents roughly a 26% year-over-year jump in profits compared to 2024.
And if we look under the hood to see what actually caused that leap, we find that total operating income grew by 22% to SAR 39.1 billion.
Now, I have to assume that to get a 22% growth in operating income for a bank of this massive size, they didn't just slash costs. You can't save your way to that kind of growth. They had to be expanding their lending aggressively, right?
You're spot on. The growth really comes down to two main drivers. First, net yield income grew by 20.1%.
Okay, and what drove that specifically?
This was driven by stable profit margins and a massive expansion in their financing portfolios. We mentioned that 50% growth in SMEs earlier.
Right.
Corporate financing as a whole went up 24%. They simply deployed more capital into the market, and they did it effectively.
And the second driver?
Second, fee-based income jumped 25.1%.
And that fee-based income is the direct result of the harmonize the group cross-selling strategy we talked about earlier.
Exactly. They saw huge boosts in fees from digital payments, trade financing, and brokerage.
Because when 44% of your users are using multiple products, those transaction fees just compound rapidly.
Precisely. It scales incredibly well.
But let me push back on one specific detail from the sources here. The report explicitly mentions that the Saudi stock exchange, Tadawul, posted steep declines and had lower than average daily turnover in 2025.
Right, the market was sluggish.
So less trading generally means less brokerage fees. So how on earth did AlRajhi Capital, their brokerage and wealth management subsidiary, manage to increase its operating income by 25% in a down market?
It's a great question.
I mean, if people aren't trading stocks, the broker shouldn't be making money, right?
Well, AlRajhi Capital didn't just sit there and rely on retail stock trading fees.
Mm-hmm.
They recognized the market conditions and they pivoted.
Oh, so they changed their focus entirely.
They did maintain a market-leading 15.5% share in traditional brokerage, which, kept a baseline of revenue flowing.
Mm-hmm.
But the real growth came because they aggressively expanded into asset management and real estate.
Wow, okay.
Yeah, and that shift drove a massive 47% income increase in those specific areas.
So when retail investors stopped day trading stocks, the bank just shifted its focus to managing long-term mutual funds and real estate portfolios. They literally moved the money to where the returns were.
It proves the resilience of having multiple revenue streams, even within a single subsidiary.
That makes total sense.
Furthermore, the bank's relentless drive for digital efficiency meant they kept their cost-to-income ratio at an industry-leading 23.3%.
That is incredibly low. So not only were they making more money through diversification, but because 96% of interactions are digital, they were spending significantly less to generate each individual rial of profit.
Exactly. It's a highly optimized machine.
Which brings us to really the ultimate lifeblood of any financial institution: cash flow and liquidity management.
Because profits look great on an income statement, sure.
Right. But a bank and its customers survive on the actual physical movement of money.
Without adequate liquidity, profitability on paper is just an illusion. A bank needs cash on hand to weather economic shocks and fund daily withdrawals.
So how is AlRajhi managing its own lifeblood?
They maintain a highly robust funding profile. Their liquidity coverage ratio stands at a very healthy 169%.
Meaning they have more than enough high-quality liquid assets to cover short-term obligations, right?
Exactly. But a major milestone in 2025 was their issuance of a USD $1 billion Tier 2 social sukuk in international markets.
$1 billion international sukuk. And for those who might not be familiar with the term, a sukuk is essentially an Islamic bond. Correct.
That's right. It allows investors to generate returns from an underlying asset without charging conventional interest-based debt.
Which is obviously prohibited in Islamic finance, but why go to international markets for it?
It did two things. First, it diversified their funding sources. They aren't just relying entirely on local Saudi deposits, they are tapping into global capital.
And the second thing?
Second, it gave them ultimate funding flexibility and capital efficiency to support long-term growth. They secured a massive influx of cash on favorable terms to continue fueling that 50% growth in SME lending.
But they aren't just hoarding this liquidity to protect their own balance sheet, are they? They're actively using it to solve cash flow problems for their customers.
Absolutely. They have specific tools for this.
For example, the report highlights a product called Tharwa. It allows small and medium enterprises to use their existing real estate assets as collateral to unlock immediate cash flow for business expansion.
Right. So imagine you own a warehouse, but you're cash poor.
Exactly. You use Tharwa to get the liquid capital you need to hire more staff right now.
They also heavily integrated Neotech's Koima accounting solution into their corporate offering.
What does Koima do?
Koima is a fully integrated SME financial platform. It connects directly to a merchant's point-of-sale systems and bank accounts, giving business owners real-time, predictive insights into their daily cash flow.
That real-time insight is critical. Cash flow bottlenecks are, the #1 reason small businesses go under.
It's the silent killer for SMEs.
If we go back to our medical analogy from earlier, cash flow is the circulatory system of a business.
For sure.
The bank isn't just managing its own blood pressure by maintaining that 169% liquidity ratio through tools like Koima predicting cash shortfalls and POS financing bridging the gap. The bank is actively building financial pacemakers for small businesses.
Well, I like that, pacemakers.
Yeah, they are ensuring these neighborhood shops don't flatline during a tough month.
And if we connect this to the systemic importance of the bank within the country, by securing their own funding through international sukuks and holding massive customer deposits, which, by the way, reached SAR $667 billion in 2025.
$667 billion in deposits alone.
Yeah. By having that, they have the deep, stable reserves required to safely extend those flexible lifelines. They are the engine fueling the businesses that drive the real economy.
So to pull all this together for you listening, AlRajhi Bank didn't just stumble into a record SAR 24.8 billion profit in 2025.
No, this wasn't luck.
And it wasn't just a byproduct of a generally good economy. They built a fully harmonized, digital-first ecosystem. They targeted distinct customer segments, from gamers wanting cashback to white-collar expats needing global transfers with pinpoint AI accuracy.
To cross-sold services brilliantly to ensure users basically never needed to leave the app.
Exactly. And they maintained strict, disciplined control over their liquidity and operational costs.
It's a masterclass in executing a unified corporate strategy at scale. But, looking through this report also leaves us with something quite profound to consider about where banking goes from here.
Really, where do you see it going?
Well, the report notes that an astonishing 97% of all retail accounts were opened digitally in 2025.
97%.
Yes, that was driven by AI-based Know Your Customer, or KYC, verification. The app uses facial recognition and direct integration with national databases to verify your identity instantly.
That, combined with open banking data sharing, means basically no one is walking into a physical branch to hand over a paper ID to open an account anymore.
Almost no one. Which raises a crucial question for you to ponder as we wrap up today's deep dive.
Let's hear it.
As banks completely transition from physical vaults holding stacks paper cash to these invisible digital ecosystems holding our entire personal, behavioral, and transactional data, will the true value of a bank in the future be based on its financial capital or its ability to securely manage and monetize our digital identity?
Wow, that is a fascinating thought to leave on. If the bank knows everything from your mortgage to your daily coffee habits, the data might honestly be worth more than the deposits.
The invisible digital nervous system is only going to get more complex from here.
It really is. Thank you for joining us on this deep dive into the architecture of modern Islamic banking. We will catch you on the next one.